Welcome back. This is Bill Bateman, and so far we've taken a look at how to open a case or read a case for the first time, and then we took a look at the introduction for a case. From there we went on to a strategic analysis and how important it is to keep that strategic analysis in mind throughout the entire evaluation process. And then we looked at projections and followed up with a short video on weighted average cost of capital. So now we're going to start looking at the discounted cash flow, and we'll start here on our projections page because we'll find that most of the information we need for the discounted cash flow is going to come from this page. So in order to do a discounted cash flow, we have to calculate our free cash flows, and if you remember the formula for that, it's EBIT, earnings before interest and taxes, times 1 minus the tax rate, plus depreciation, minus CapEx, and then plus or minus the change in net working capital. So you'll see that even though they may have different names here, all but one of these variables is on this page. Consolidated operating income, that's actually EBIT. Okay, earnings before interest and taxes. And then we have our capital expenditures and our estimated depreciation expense. So the only thing we don't have would be the change in net working capital. In the Mercury case, they've given us a head start on this by showing us select balance sheet accounts and then actually calculating the net working capital. This is not the number that you want to use in your free cash flow. What you want to use is the change from one year to the next. So for 2007, in calculating free cash flow, we'd use 4,567. That's the difference between 2006 and 2007. And because that amount increased, it's a use of cash, and so we're going to want to decrease our free cash flows in this case, or subtract $4,567. So let's go to our discounted cash flow chart, and you'll see that we start off with NOPAT. Okay, here's another new term for you. NOPAT is really earnings before interest and taxes times 1 minus T. NOPAT stands for net operating profit after taxes. It's the same thing as EBIT times 1 minus T. And I can prove that by taking our projected income of $47,005 times 1 minus T, which is 0.6 with a tax rate of 40. You'll see that we come to 28,203, which is, on our discounted cash flow, the first year's NOPAT, or EBIT, times 1 minus T. We then add depreciation because it's a non-cash expense that was included in NOPAT, or it was deducted as part of getting to NOPAT. Subtract out the change in net working capital, which again we got from this sheet here by calculating accounts receivable plus inventory minus payables. Although this author uses some other accounts in his or her calculation of net working capital, for our purposes we're only going to be using accounts receivable, inventory, and accounts payable. So we use their number, and then we subtract out the capital expenditures to come up with our free cash flows for the planning horizon of 5 years. The next thing we do is take our weighted average cost of capital, which we've already calculated, and come up with a present value factor for each of the 5 years. Or you could use the Excel NPV function and figure out your sum of the present value of the future of the free cash flows, which come out to 91,165. The next thing we'll do is calculate our terminal value. And if you remember the Gordon growth rate model, The formula for terminal value is the free cash flow for the nth period times 1 plus little g. Okay, the free cash flow for the nth period is the last period in our planning horizon, and in this case that would be the 2011 year. And then a little g, if you remember, is the growth rate, and the author for this case has decided on 2.78% for the long-term growth rate. We divide that by WACC, or the weighted average cost of capital, minus little g. So the math here is 29,545 times 1.0278 divided by 1106 minus 0.0278. If you do the math, it comes out to 30,366 divided by 0.0828, and the final answer is 366,743. Now, I realize that's different from the answer that the author put in, and the best I can tell is that it has to be a rounding error that the author of the case didn't describe. So if you take the terminal value in 2011 and discount it back, remember to discount it back using the present value factor for year 5, you come out to 2017, $292, added to the sum of our present value of our free cash flows, and we see that we have an enterprise value of Mercury Athletic on a discounted cash flow basis of $308,458.